Welcome to Breaking News to Trading Moves.
Glad to be here.
Today we are looking at a corporate strategy that, on the surface, might seem a little counterintuitive, maybe even reckless to some.
That's a good way to put it.
We're focusing on Meta Platforms, ticker META, and it's absolutely massive spending on artificial intelligence infrastructure.
Right, and what that spending really means for the rest of the market. It's a classic story where the headline number, the cost, is just so big it kind of hides the potential upside.
It really does, because when you hear a company is ramping up its capital expenditure or capex, the first reaction is usually negative.
Always. The market immediately thinks about the drag on earnings, on cash flow, and that almost always puts pressure on the stock, at least in the short term.
And the numbers we're looking at here they're just hard to get your head around. The plan is for Meta to increase its AI spending from under $40 billion in 2024.
Which is already a huge number.
A huge number, yes. And they're projecting that to go to over $100 billion by 2026. That's almost tripling an already enormous expenditure in just 2 years.
That kind of cash outlay is, it's enormous. But here's the twist, and it's the whole reason we're talking about this.
Go on.
There's one Wall Street analyst who's looked at this exact plan, this $100 billion number, and is projecting that Meta could still rally by about 70%.
70%. So the big question, the one we're going to get into today, is how? How can that level of spending possibly lead to such an optimistic forecast?
Exactly. It seems like a contradiction.
So our mission today is to get past that $100 billion sticker shock. We're going to lay out the mechanics behind that optimistic view, look at what Meta's AI is already doing for its revenue.
Which is the key part, the already.
And then we'll map out who the predicted winners and losers are across tech, media, and advertising because of this strategy. And this is all structured for you, the listener, to give you a clear map of what's happening. Okay, so let's start with the money itself, the sheer scale of it. Meta is committing to spend over $100 billion on its AI capex.
And we need to be clear, this isn't just about buying a few more servers.
Yeah.
This is a foundational investment. It's about reshaping their entire business, their entire infrastructure around AI.
It feels like a massive calculated gamble. I mean, if you're a traditional investor looking at quarterly reports,
You'd think it's reckless. You'd see the cash going out the door and get nervous.
yeah.
But Meta is trying to prove a very specific thesis here.
Which is what?
The AI spend pays for itself strategy. It's a bet that the revenue generated by the AI will grow faster than the cost of building it. And not just eventually, but quickly.
That's the whole justification then. The analyst's optimistic view rests completely on Meta, proving this isn't just a cost center, but an investment with a clear near-term return.
Right. It's not some far-off theoretical benefit in a decade. It's about measurable returns now.
But why is there so much confidence this time? We've seen big tech companies spend billions on projects before that. Didn't exactly pan out.
Because they already have the proof of concept. And this is the most important part of the argument. The optimism is fueled by the fact that Meta's current AI ad tools are already generating tens of billions of dollars in revenue.
Right now.
Right now. This isn't a projection. It's existing operational cash flow from the AI systems they have today.
Okay, so let's get specific on that. When you say AI ad tools, what does that actually mean? What is it that's bringing in tens of billions of dollars?
We're mostly talking about their Advantage Plus suite of products, specifically something like Advantage Plus shopping campaigns.
And how does that work for an advertiser?
It's basically an automated end-to-end system. An advertiser, say, a small online store, just uploads their photos, their videos, their text, and sets a budget. And from there, Meta's AI engine takes over everything else. It handles the targeting, figuring out who to show the ad to. It manages the bidding in the ad auction. It even tests different variations of the ad creative to see what works best.
And it's doing all this in real time.
Constantly. The AI models are learning with every single impression, every click. They're figuring out which users are most likely to actually buy something and adjusting the ad delivery just milliseconds before you even see it on your phone.
So the $100 billion spend is essentially to pour gasoline on that fire, to make that existing proven engine even better.
That's it, exactly. When you have a system already making tens of billions, every tiny improvement in its efficiency has a massive payoff.
How so?
Well, think about it. If the AI can get just 1% better at predicting who will buy a product, that 1% improvement in the conversion rate can translate into hundreds of millions, maybe even billions, in additional revenue.
For Meta and for the advertiser.
For both. The advertiser gets a better return, so they spend more. Meta gets more of that spend. The money is needed to buy the hardware, the chips, the networking gear, to train and run the next generation of AI models, like a Llama 3 or 4.
And those new models will be even better at predicting user behavior and optimizing ads.
By an order of magnitude, it creates a positive feedback loop.
It sounds like one. They spend on chips. The chips power a better AI. The better AI improves ad performance. Advertisers get a better return and spend more, which then justifies
Spending even more on chips. That's the whole narrative that supports that potential 70% stock rally.
So the market might be misjudging this. They see the $100 billion cost, but they're not fully appreciating the compounding returns from the ad engine it's building.
I think that's the analyst's view. Traditional logic sees $100 billion as a hit to cash flow. This view sees it as buying the machinery needed to generate hundreds of billions in future high-margin ad revenue.
Okay, but let's be the skeptic here. What's the risk? Why might the market be right to be concerned? Because $100 billion is a serious liability if this doesn't work out as planned.
The risk is definitely there. It's mostly in execution and competition. First, supply chains. Getting these specialized AI chips isn't like buying servers off the shelf. There are bottlenecks. If Meta runs into major delays getting hardware from, say, NVDA.
Then the spending happens, but the improved performance doesn't.
Exactly. Or what if the models plateau? What if the next $60 billion in spending only gets the marginal, tiny improvements in ad performance? Then that cost becomes a stranded asset, a bad investment.
And what about the competition?
That's the other big risk. If a competitor, maybe Google with its own AI, or even Amazon, develops an even more effective ad tool that starts stealing market share, Meta's whole investment is suddenly at risk.
But the core of the optimistic case is solid because it's based on existing real revenue, not speculation.
Correct. As long as they can keep innovating and improving that return on investment for advertisers, the spending is a growth lever, not just a cost. The scale of this spending is designed to be a weapon.
A weapon.
Yes. By spending this much, they are deliberately raising the price of competing so high that almost nobody else can afford to even stay in the game. It protects those tens of billions they're already making and lets them capture even more of the future market. It's a war fought with capital and data. So if we accept that Meta is committed to spending over $100 billion, the first and most obvious question is, where does that money go?
Right. It doesn't just vanish. It flows directly to the companies that supply the literal nuts and bolts of AI.
The building blocks. So our first category of clear winners are the infrastructure providers, the ones selling the shovels in this AI gold rush.
This is the most direct cause and effect link in the whole story, isn't it?
It is. Meta's capex plan translates directly into a predictable multi-year pipeline of demand for some very specialized hardware. And we're not talking about standard servers you'd find in any old data center.
What are we talking about, though?
We're talking about the absolute highest-end stuff available. The most powerful graphics processing units, or GPUs, which are the engines of AI. The massive high-speed networking equipment you need to connect thousands of those GPUs together. And even some specialized custom-built chips.
Okay, let's start with the big one. NVDA, ticker NVDA. They're at the center of all of this. How does Meta's plan specifically impact them?
For NVDA, this is a guarantee. It guarantees sustained, high-volume, robust demand for their products for years to come. That kind of visibility is incredibly valuable for planning and for maintaining pricing power.
And a huge chunk of that $100 billion is going right to them.
A very substantial fraction. We're likely talking tens of billions of dollars just for NVDA's high-performance chips like the H100s and whatever comes next. And Meta needs these chips for two distinct critical jobs.
What's the first one?
The first is training. Meta's big AI models, like their Llama series, are just colossal pieces of software. To teach them, to train them, you have to run these mind-bogglingly complex calculations on huge data sets for weeks, even months at a time.
And NVDA's chips are the best in the world for that.
They're the industry standard. So when Meta says they're increasing capex, it means they're planning to train bigger, more powerful models and do it more often. That means more NVDA chips.
Okay, so that's training. What's the second job?
The second is inference. Once your model is trained, you have to actually use it. You have to deploy it to serve billions of users in real time. That's called inference.
And that's what's happening every time I see an ad on Instagram.
Every single time. For a sophisticated task like optimizing that ad in real time, which is what's driving those tens of billions in revenue, you need incredibly powerful GPUs to make that decision instantly.
And given Meta's scale, Facebook, Instagram, WhatsApp, They need an unbelievable number of these inference chips.
A vast number. They have to build out these huge inference clusters just to handle the sheer volume.
Hmm.
So Meta's commitment gives NVDA this crystal clear roadmap of future orders for years out.
That's a massive strategic advantage for NVDA over any of their competitors who might be dealing with more stop-and-start demand.
It's a gold mine for them. They know that revenue stream is locked in. That lets them pour money confidently back into their own research and development for the next generation of chips, which just cements their lead even further.
Okay, so that's NVDA. The outline also points to another big infrastructure winner, AVGO, ticker AVGO. They're in networking and custom chips. What's their role?
If the GPUs are the brains of the AI data center, AVGO provides a lot of the critical parts of the nervous system.
The nervous system, I like that.
They specialize in the components that let those hundreds of thousands of GPUs talk to each other at incredibly high speeds. When you cluster all those brains together, they have to communicate instantly, without any lag, or the whole system grinds to a halt.
And AVGO makes the specialized gear for that.
Exactly. They provide things like optical components and specialized silicon for Ethernet switches and routers that can handle the massive bandwidth AI requires. Your standard data center networking gear would just create a traffic jam. It would be a huge bottleneck.
So Meta can't just buy off-the-shelf networking parts.
Not for this scale. They're building custom unified AI network fabrics that are optimized from the ground up for this kind of massive data flow. A VGO is a key supplier of the advanced custom silicon that makes that possible.
And what about the custom accelerators part? How does AVGO play a role in Meta's own chip design?
Well, many of these big tech companies, the hyperscalers, are trying to design their own custom chips. They're sometimes called ASICs.
Right.
Because if you have a very specific task you do billions of times a day, like ranking ads, you can often design a chip that does that one job far more efficiently than a general-purpose GPU.
So they get more performance for less power, less cost.
That's the goal. But designing and manufacturing these custom chips is incredibly hard. You need very specialized expertise. AVGO is a major supplier of the intellectual property and the customized components that go into these sorts of highly technical semi-custom silicon projects.
So IVGO wins twice. They win from the build-out of the networking that connects all the NVDA chips.
Right.
And they also potentially win by providing the expertise or the parts for Meta to build its own unique chips to make its AI models run even more efficiently.
Precisely. They're positioned at the really high-value, customized end of the hardware supply chain. So the key takeaway for you, the listener, is that this $100 billion spend isn't just good for the main chip designer. It creates this sustained cascade of revenue for all the specialized companies that provide the essential plumbing and the custom brains that make these AI factories work.
Okay, so we've got the direct hardware suppliers. They're the most obvious winners. But the success of Meta's strategy seems to have a validating effect on the rest of the tech world, too.
It does. It has a broader effect, starting with the other giant tech companies, the ones we often call hyperscalers.
And this is about something called the hyperscaler thesis.
Right. And for a long time, the market has been pretty skeptical of big tech companies spending these enormous sums on capital projects. The traditional view is that companies should be efficient and return capital to shareholders through buybacks or dividends.
Not spend it all on building new data centers.
Exactly. The hyperscaler thesis argues the opposite. It says that in the age of AI, this kind of aggressive multi-year spending on infrastructure isn't a waste. It's actually a necessary defensive move and the main driver of future growth.
Because if Meta pulls this off, if they spend over $100 billion by 2026 and their stock actually rallies 70% because their AI is making so much money,
then the market is effectively saying, okay, this model works.
it changes the whole story.
It completely changes the investment narrative. All of a sudden, high capex isn't seen as wasting cash anymore. It's seen as making smart, profitable investments that create an unbeatable advantage.
And that validation then helps the other big tech players who are doing the same thing.
Immediately. Let's look at MSFT, ticker MSFTT. Their investment in AI, mainly through their Azure cloud platform and their partnership with OpenAI, is absolutely massive.
So how does Meta succeeding help MSFT? Their business models are different.
They are different. MSFT makes money from enterprise software, from cloud services, not from consumer ads. But the underlying principle is identical. You make a massive investment in infrastructure to create new, high-margin ways to make money.
I see.
So if Meta proves that the capex model works for their consumer-facing AI ads, It just strengthens the market's belief that MSFT's big bet on enterprise AI will also pay off. Things like Copilot or other AI-powered cloud services.
So even though MSFT is already spending a fortune to bake AI into all their products, Meta's success makes investors more willing to believe that MSFT's spending will also lead to strong profits down the road.
That's the key link. The market tends to group these hyperscalers together. If one of them proves that massive AI spending can be translated into revenue growth at scale, all the others tend to benefit from investors being willing to pay more for that future growth potential.
And it's a similar story for AMZN, ticker AMZN. Their spending is spread across their e-commerce business, logistics, and of course, Amazon Web Services, AWS.
Right, and AWS is their real profit engine. They are spending heavily on their own AI infrastructure to compete with Microsoft's Azure. They're even developing their own custom AI chips, like Trainium and Inferentia.
A huge capital outlay.
A huge one. So if Meta establishes the precedent that this kind of aggressive AI capex is a good thing, a revenue accelerator, then AMZN's spending on its own data centers and chips starts to look like a very prudent, forward-looking strategy, not just a drain on their earnings.
It justifies their investment in the eyes of the market.
It does. Meta's success buys them time and patience from investors. It gives AMZN more room to innovate and scale up their AI offerings because the market is now conditioned to reward that kind of long-term infrastructure bet.
Okay, now let's circle back to the advertising world itself, where Meta is actually making those initial tens of billions.
Right. And the central idea here is that a strong market belief in AI-driven ad performance is going to favor the platforms that can prove they give advertisers the best return on investment, or ROI.
And to prove that, you need two things: immense scale and a ton of data.
You do. You need billions of users providing constant feedback so you can train these really sophisticated, high-performance AI models. It's a game where only a couple of players can really compete at the highest level.
And Meta, ticker META, is obviously the #1 beneficiary of its own strategy. They have the scale, the data, and now the clear willingness to spend over $100 billion to build the AI to leverage it.
It's the perfect combination for them. Every dollar they spend on capex just makes their advantage bigger. They don't just win in this scenario. They create an environment where it's geometrically harder for anyone else to even try to win.
And the other big ad giant that benefits from this is GOOGL, ticker GOOGL.
Yes, because if Meta proves the AI-driven ad model is the future, it benefits GOOGL too. They benefit from that rising tide.
How so?
Well, GOOGL, through its search and YouTube platforms, has data resources that are arguably even broader than Meta's. They capture user intent through search, which is incredibly valuable.
Right, what people are actively looking for.
Exactly. So if advertisers become completely convinced that AI is the key to maximizing ROI, they're naturally going to consolidate their ad budgets on the two biggest, most data-rich, and most technologically advanced platforms.
Which are Meta and GOOGL.
Meta and GOOGL. So Meta's success validates GOOGL's own ability to make money from its advanced AI ad systems, and it helps secure their shared dominance over any smaller competitors. It confirms that in digital advertising, performance is now tied directly to AI capital spending, and only the giants can afford to compete in that arms race.
So if all this capital, all these ad dollars are flowing towards Meta and GOOGL because of their AI performance, then that money has to be coming from somewhere else.
It does. And this brings us to the sectors that are predicted to lose out, starting with what we call legacy media.
Traditional TV and so on.
Right. And the reason they're expected to struggle is because of something called the measurement problem.
Okay, what is the measurement problem exactly?
It's the massive gap in how you can measure the effectiveness of an ad on, say, traditional TV versus a sophisticated digital platform like Meta.
Explain that difference.
Well, linear TV broadcast, cable, it offers you a huge audience. But the measurement is it's probabilistic. They estimate who saw your ad using sampling methods, like Nielsen ratings. They can give you a good guess on demographics and reach.
It's a guess.
It's an educated guess.
Yeah.
They can't tell you for sure that a specific person saw your ad and then went and bought your product. In contrast, Meta's system offers what's called deterministic measurement.
Deterministic, meaning what?
Meaning the advertiser knows, with a very high degree of certainty, that user X saw ad Y on their Instagram feed, clicked on it, went to the advertiser's website, and completed purchase Z. The whole path is tracked.
And Meta's AI is built to optimize that entire path to purchase.
Exactly. So when a marketing executive can see a clear, provable return on their ad spend on Meta, it becomes very, very difficult for them to justify continuing to pour huge parts of their budget into big, less measurable TV campaigns.
The push is for efficiency, for proof of what's working. And that naturally pulls budgets out of the traditional world and into the digital one.
That's the dynamic. And the companies that are most reliant on those traditional ad dollars are the ones that feel the pressure first.
Like PARA, ticker PARA, with their broadcast and cable networks.
Yes, they're challenged because advertisers are now demanding that granular user-level ROI measurement that only the digital platforms can really provide. Their TV ad inventory is just inherently less measurable and less targeted than what Meta's AI can deliver.
And it's a similar situation for FOXA, ticker FOXA.
Same challenge. If the whole ad industry shifts to believing that AI-driven ROI is the new gold standard, and Meta's proving it is, with tens of billions in revenue, then companies like FOXA have to deal with a shrinking pool of ad dollars that are still willing to pay for broad reach over measurable conversions.
So the whole competition is changing. It's not about who has the most eyeballs anymore.
It's about who can guarantee the highest verified conversion rate. And that's a technology problem, not a content problem. The legacy media players are just at a major technological disadvantage in this new arms race.
Okay, so that's legacy media. But what about the other digital platforms? The ones competing in the same space as Meta, but without their deep pockets.
Well, that's their existential challenge, isn't it? The winning formula, according to this analysis, is clear. You need massive scale plus massive AI investment.
And if that's the formula,
then the smaller social players simply cannot keep up. They can't match Meta's spending, and so they risk losing the ability to compete for the same performance-focused advertising dollars.
the gap in spending is just staggering. If Meta is on track to spend over $100 billion by 2026, how can a smaller competitor even hope to stay close in terms of technology?
They can't. It's that simple. And that deficit means their ad optimization tools will inevitably start to fall behind what Meta can offer.
And advertisers always follow the best ROI.
Always. Especially the big e-commerce and direct-to-consumer brands. If Meta's AI can deliver a 15% better conversion rate than a competitor's, the budget is going to move to Meta. It's a ruthless calculation.
SNAP, ticker SNAP, is a prime example here. They're competing directly with Meta for ad dollars from the same brands for the same eyeballs.
They are. And SNAP's big selling point has often been its unique reach with the younger Gen Z demographic. But the value of reaching that audience starts to fade if you can't efficiently convert them into customers.
So advertisers might eventually decide it's better to just go with the platform that delivers the maximum return, even if the audience on Meta is a bit broader.
It's a real risk for them. And you see a similar challenge for PINS, ticker PINS. Their platform is all about product discovery and inspiration, which seems like a perfect fit for visual AI.
It does.
But developing the really sophisticated AI you need to perfect product recommendations and ad placements at scale, well, that requires the same $100 billion type of investment that Meta is making.
It's an arms race where the price of a single bullet is rising exponentially.
That's a great way to put it. If you can't afford the $100 billion investment, your AI will eventually be second-rate, your ROI for advertisers will drop, and they will go elsewhere. For companies like PINS and SNAP, Meta's massive spending plan acts almost like a financial wall, creating a competitive environment where just keeping up becomes economically impossible. So we've talked about the direct hardware suppliers, the direct ad competitors. But there's a third group that's affected by Meta's success, and it's a bit less obvious.
Okay.
It's the technology companies whose stock prices are based more on a long-term story or vision, rather than on their current profits.
Right. The story, not cash flow names, as they're sometimes called. Their value is tied up in the promise of what they will be, not what they are today.
Exactly. And the context here is so important. Meta is demonstrating right now very clearly monetized AI spend. This isn't a promise about the metaverse in 2035. This is tens of billions of dollars in real revenue today from their existing AI ad tools.
So they're providing tangible, measurable proof that a huge investment in infrastructure can produce an immediate and massive return.
And the consequence of that is that it raises the bar for everyone else.
Yeah.
The market's expectations have just been reset.
How so?
Well, now these other tech companies, especially the ones with big AI visions, have to show a much clearer and faster path to making money from their own plans. This is especially true if their current cash flow is weak or negative.
So investors are being trained by Meta to demand an immediate ROI from big AI spending projects.
Patience is wearing thin. If a mature, giant company like Meta can prove that ROI at scale, investors are going to start looking at younger growth companies and asking, okay, where are your tens of billions in revenue to justify all this spending you're planning?
So they'll be less willing to fund long-term projects that don't have a clear path to profitability.
That's right. Let's take RBLX, ticker RBLX. It's mentioned as a company that could face more scrutiny because of this. They're building this massive platform that needs huge investment in virtual worlds and creator tools and in the AI that powers it all.
A very story-driven company.
Very. And their focus is on building a long-term virtual economy and user engagement.
Hmm.
But when Meta comes along and shows that its AI spending is generating concrete ad revenue right now, investors might start asking tougher questions about RBLX's current monetization.
Which is based on virtual currency and creator fees.
Right. The questions will shift from, is the vision of the metaverse a good one, to how quickly and predictably can that vision turn into high-margin cash flow from AI-powered services?
The pressure builds for them to show that their AI investments are leading directly to more immediate economic activity on the platform, not just a better user experience in 5 or 10 years.
And you see the same potential pressure on U, ticker U. There's a 3D development platform used heavily in gaming, where AI is also becoming critical for creating content and building worlds.
But their business model is different. It's based on subscriptions and licensing for their tools, not ads.
It is. But like RBLX, they could feel pressure to show very clear, tangible returns from their AI projects that can stand up to the new bar set by Meta's ad revenue.
So investors will want to see that developers are paying more for their tools, specifically because of new AI features.
Exactly. Investors might become less willing to fund long periods of high spending on AI development without seeing a strong, growing revenue stream directly tied to those new AI features. If capex is rising to build powerful AI, the revenue from it needs to be rising just as fast.
So Meta's performance is shrinking the market's patience for story without the cash flow to back it up.
I think that's the bottom line. It's a recalibration of market expectations across the whole tech landscape. Meta's proven ability to turn a massive capital investment into high-margin revenue becomes the new yardstick. If you're out there selling a big vision that requires a ton of AI infrastructure, the market is now going to want to see proof you can make money from it at a similar rate. It forces a faster path to profit.
So to sort of wrap up everything we've covered, this entire market analysis really comes from 2 key things.
Right.
First, you have Meta's decision to commit over $100 billion by 2026 to its AI infrastructure. An incredible number.
And second, you have the underlying belief, which is backed up by their current revenue, that their AI ad tools already justify this spending and will actually multiply its value over time.
And that 1-2 punch creates some very clear winners. NVDA and AVGO on the hardware side, who are catching that direct flow of spending.
And then you have MSFT, AMZN, META itself, and GOOGL, who all benefit from the big picture validation that this level of AI investment is what drives market leadership and higher valuations for big tech and digital advertising.
On the flip side, this same dynamic creates big challenges for the legacy media companies like PARA and FOXA because of that measurement problem we talked about.
And for the smaller social platforms like SNAP and PINS who just can't afford to compete in this new capex arms race.
And finally, for those narrative-driven tech companies like RBLX and you, who now have to deal with much higher expectations from the market about how quickly they can turn their own AI visions into actual profit.
Right. So here's a final thought for you, the listener, to consider. The core idea here is that high-performance AI is changing how companies spend their advertising budgets, which is really just the cost of acquiring a customer.
Okay.
So if these expensive, low-measurement methods are being abandoned in advertising, what other big-budget sectors might be next? Think about things beyond what we talked about today, maybe large-scale industrial maintenance or legacy sales software, or even traditional call centers. Which of those might see their budgets reallocated next, forcing a similar showdown between the old, expensive, imprecise ways of doing things and the new, highly efficient, AI-driven approaches?
We want to remind you that this discussion of market movements, company strategies, and analyst predictions is based purely on the information we analyzed.
This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.